I want to talk a little bit about Module 12 tonight. Module 12, it's easy. It's all review. It won't take me long to zip through the PowerPoints, and I'm very hopeful that everybody online recognizes this as review material because it should have been part of your first investments class, a little bit of your first finance class. We're talking about cost of capital tonight. Basically, how much investors require to invest. You don't put your money to work unless you expect a return on that money. And how do you quantify that? So we're gonna zip through CAPM tonight, review the capital asset pricing model, and that tees us up for a discounted cash flow analysis next week, and that's review also. But you won't be tested on that. Tonight is the end of the testable material. So I already went out to the My Business course website and I turned on the third exam. So you're going to be able to take that anytime between right now, it's on, and 2 weeks from now, which is the 15th at midnight. So anytime in that 2 week window, you can go take that final exam. And then basically that's about all we have by the 15th. The semester's winding down, so that's also the same window when we need to finish up our research projects. So the rest of the semester is just going to be us getting together to workshop those. I'll do a little bit of lecturing over modules 13, 14, 15, but not much because the homework is the only points you have based on those models. Otherwise, it's really just application, and the application that comes in your research projects. So that's a brief overview of the rest of the semester. Hit me with some questions. How's everybody doing? On track with the research projects, homework? Okay on the tests? Anybody got any questions you want to address? Fire away. Yeah.
So Professor, when is the last date to submit the research project? Is it 15th or the
When's it due, you say? Um, I'm just so lenient with that. I don't remember when the university has requires me to have grades in, but I need that research project 3 days before I'm required to turn grades in. So let's say, yeah, it probably needs to be. I suspect that the university is gonna need my grades in that week of the 15th. So let's say I need it by the 15th. Great question.
so it will be the research project, the document that we're preparing, a presentation on it, um, as in the PPT, and that's it.
Thank you for asking that question. There is a video that accompanies this research project, and the video is required to be submitted. Just you can submit it via Canvas, and you
Mhm.
can submit it along with your research report. And just give me a link. Either you shot that in Panopto or you posted it to YouTube or some other, whatever media platform is most user friendly for you. Just give it to me in a link so I can watch it. And I want that 3 minutes. I don't need a PowerPoint. I prefer not to have a PowerPoint. Most students who use a PowerPoint get all caught up and lost in what they're trying to tell me. 3 minutes is barely enough time to cover the four M's.
Mhm.
And basically you're just communicating to me verbally what's on the front page of your report. That report is designed for a brief overview of the company. It goes into management, moat, mispricing, and mark. You spend 30 seconds on each of those, talk about the major risks associated with the business, and then wrap it all up in a tight-hitting thesis, and that's 3 minutes. I mean, it's no problem. But if you bring a PowerPoint to support that, I notice students have it typically go long. You'll lose points if you go long. I don't have time to be listening to a 10-minute presentation. I don't want to listen to a 10-minute presentation. So don't go long. I'd rather have it 2 minutes than five.
Thank you, Professor.
Yeah. And just you guys know what's going on here. We're encouraged by the university to send everybody out of here with a degree that communicates some public speaking skills. So I want to see that. And I used to do it in person, but it just seemed to be much more well received by everybody in class to take that video. I know how stressful things get at the end of the semester. If you give everybody a little bit of time to do that on their own, it works better. All right. Well, the microphone's live. Just interrupt me at any point, and I'll jump into module 12 here. So let's share my screen here first. Let me go over and right size this presentation. Bear with me. Share screen two. Okay, can you see the PowerPoint presentation? Okay, great. Excuse me. Cost of capital and valuation basics. We're taking an overview, a very brief overview of the whole semester here, and that comes up in a few slides, and I'll give you some insights on, how we got from point A to point B. Tonight we're talking about cost of capital, and that's the easiest way I can explain it is just the cost of money. And we already had a full lecture on the cost of debt, and we talked about the ratings agencies and how risky your company is with more debt. They have to pay a higher interest rate, and those interest rates are dictated by the bond market and they're dictated by major banks and other lending institutions. Well, this is the same conversation, only we're talking about equity investors. So now let's imagine that everybody on the line is an equity investor and we're getting ready to invest our money in one of the companies that we've been looking at all semester. And we wouldn't do that unless we expected a rate of return. And we call that cost of capital. How much does the company, quote unquote, owe us as investors when we give them their money? And that's a very theoretical conversation. And we're going to talk about CAPM tonight, which is the most prevalent model of calculating and determining that cost of capital. But it has big time bugs in it. It's just, there's a lot of assumptions that go into that model, and I'll point out a few that they just it's the best we got, but it's still not very good, which is you all know I'm a big fan of Warren Buffett, and one of the simplest ways that you can compute a cost of capital, and the way he did it was just to take the bond rate, so whatever a particular company is paying to their bondholders or their bank, and add an additional 3%. Because as an equity investor, you take on more risk and you should be compensated for that risk. And Buffett always figured that, well, if he could add 3% of that. That was fair compensation. And then he took the added step anytime he did analytical work or a discounted cash flow, which was usually a back of the napkin calculation for him. He'd add a margin of safety. So if he used the cost of capital at 8 or 9 or 10 and it determined a business was worth $100 per share, he'd add a margin of safety to that. And he'd say, okay, well, that means I'm going to buy if it ever gets to 80 because well, it's just like what it sounds like. It's a margin of safety. So if you do something wrong or have a miscalculation or the future just unfolds in a manner that was unanticipated or unexpected, that margin of safety adds exactly that, a little bit of safety. So why do we need a cost of capital? I mentioned the discounted cash flow, and you can use a discounted cash flow in an initial public auction. You can use it in a merger or acquisition. All semester long, we've been behaving as if we were collectively working inside of a mutual fund company. So we analyze stocks and we try to determine how much they're worth. And we're going to build a discounted cash flow analysis. And we're going to discount all of the future cash flows back to time zero. And we're going to add that up. Theoretically, this should sound familiar. Theoretically, a company is worth the present value of all of the future cash flows that it will earn into perpetuity. And we can calculate the value of that with a simple Excel spreadsheet. But in order to do it, we have to have a discount mechanism. And that discount mechanism is this cost of capital. And here's the preview of this is our whole class. This is our whole class, and it should look very familiar. We started, gosh, 12 weeks ago now with step number one, modules one and two. We're understanding the business environment and accounting information. So when we're looking at cost of capital, well, we want to understand what a business is paying for its debt. We would expect the cost of equity capital to be a little bit more expensive. We want to understand what that cost is for its competitors. We want to understand the relative risk of company A versus company B in the marketplace because that'll affect their cost of capital. Then we moved on to step number two, which was an in-depth analysis of accounting as it related to modules 3 through 10, and we talked about lease accounting and taxes and so on and so forth. Last week we talked about forecasting that financial information after all of the adjustments that we made all semester long, and now we're into the step four phase of the class, which is valuation basics. And I like how this class has evolved over time. I like for that step four to really be an application of everything we've learned in the research project. So we have a little bit of overlap. I needed four modules for the third test, so some of those valuation basics end up on the third exam. Okay, let's talk about the equation that we're going to use to calculate this cost of capital. And you can see this IV firm equals IV debt plus IV equity. And IV is intrinsic value. So the intrinsic value of the firm equals the intrinsic value of the debt. So we're thinking about the market value there. If you went out into the market and you bought back all that debt, you'll recall that sometimes the company's debt trades at a premium or a discount. So it's not the same thing as the number that's printed on the balance sheet, although many times, most of the time, it's going to be pretty close. And then the intrinsic value of the equity is the same thing. If hypothetically you could buy every share of a company's basic stock outstanding, you would have its market cap or the intrinsic value of the equity. And the intrinsic value of the equity plus the intrinsic value of the debt is the intrinsic value of the firm. And the theory behind the capital asset pricing model is that that value of the firm is equal to the present value of all of the cash flows that the firm will generate, which means that we have to be familiar with the cost of debt and the cost of equity both. And that ratio will determine what we call our weighted average cost of capital. I'm getting a little ahead of myself here, but we'll circle back around to that. Here's a review slide. We start with cost of debt. If we're moving towards a weighted average cost of capital to discount future cash flows, then we're going to start with the cost of debt. And this is 100% review. This takes us back to module 5, I think it was, where we talked about the present value of a bond and the discount or premium it can trade at. And that's a very simple calculation because we know what the interest payments are going to be. You'll recall that those were coupon payments, and those are set. A bond pays a set coupon every semi-annual period. And in this example, a bond's paying $90 this is every year. And the return of the principal is in year three. Discount those cash flows back at 9%, and you see the total value of the bond at the bottom of the screen there at 975. That's all by way of example so that we can focus on cost of equity capital. So cost of equity capital is very similar. We're going to look at the future cash flows generated by the equity of the business, and we're going to discount those back at some interest rate, at some cost of capital. And this is theoretical, so let's break it down. In this graphic, you can see that cost of capital for equity shareholders is broken down between the green circle here, which is the time value of money. So the time value of money is the risk-free rate. And for the purposes of this class, we're going to use the 10-year bond rate. Let's just say that's currently at 4%. And then we're going to add to that some additional number in the blue circle there, which is compensation for bearing the risk associated with uncertain payoffs. This just means, hey, this company's not risk-free. And if it's not risk-free, I'm not going to invest in it unless it's paying me something more than 4%. If I can get 4% on a 10-year bond, and I plan on owning this company for about the same period of time, Well, I'm going to require something more than four. Probably, what are we collectively going to require? That's kind of an open question. I won't make anybody answer it because Zoom calls aren't the best for that type of thing. But historically speaking, the market has returned about 10%. So if we think a company's as risky as the market, then it would be reasonable to expect 10. Now, you as an individual investor may say to yourself, well, I think this company is more risky. So I'm going to require 15 or I'm going to require 20. Okay, great. If that's what you require, you may or may not get the chance to buy the company because the share price is the collective assumptions that every investor in the market has made based on the company that I don't know, if we're looking at Pfizer and I have a cost of capital for me personally at 20. Well, that would, if I discount all the future cash flows back at a 20% cost of capital and Pfizer's trading at $100, I may only be willing to pay 60. It would have to trade at 60 for me to earn that rate of return. And I may not ever get the chance because other investors are willing to pay more. And if another investor is willing to pay more for that same share of stock, you can invert that. That's the equivalent of another investor saying, I'm willing to pay more or I'm willing to earn less. My cost of capital is less, and therefore I can afford to pay a higher price for that stock. So look at the way these two things add up. You have a risk-free rate, and then you have compensation for risk, and that determines your cost of capital. And the lower your cost of capital, the higher your share price. Okay, well, what happened this week in the markets? I guess last week and the week before, the markets have been on a big run up. They've recouped a lot of the losses that they had accrued, I guess, in the last 6 weeks, primarily on speculation that the Federal Reserve is going to lower interest rates again. There's an 80% likelihood that the Fed's going to lower interest rates if you just look at the markets. So if the Federal Reserve lowers interest rates, then the cost of capital for investors across the spectrum is going to be a little bit lower. And if the cost of capital is lower, well, then investors are willing to pay a higher price for the same rate of return. Okay, moving on. Okay, now let's get a little bit wonky and move into the capital asset pricing model, which is another way of identifying and calculating what the cost of capital should be for equity shareholders. And one of the ways that we're going to kind of get at that basic equation is to differentiate between diversifiable and non-diversifiable risk. So think about diversifiable risk as being the market portfolio. If the market portfolio has a set rate of volatility and a historical expected return, which I just identified at about 10%, then that's the amount of risk that we can diversify. No additional diversification is going to allow us to lower our risk beyond that specific threshold. And then non-diversifiable risk would be the risk associated with a specific company. So let's look at an example. Here's how we put that into the capital asset pricing model. So let's start with R of E. That's the risk associated with an individual equity. So cost of equity. That's going to be set equal to the risk-free rate. So that's the time value of money that we just identified on slide number 12. And then we're going to add some risk premium. So the risk premium is identified in blue there. R sub M, which is the historical return on the market, less R sub F, which is the risk-free rate, equals a market risk premium. So right now, I just identified the 10-year treasury at 4%. And if the market has historically returned 10, then 10 minus 4 is 6%. That would be the risk premium. And you can see our author's note there that historically that premium fluctuates between 4 and 10. So They're using 5, and I just calculated it at 6, so we're right in the range. And then the key term on this slide is beta, market beta, defined as the sensitivity of the asset's return to the overall market. So if we're looking at a tech stock, and it's got a lot more volatility than the market, that beta might measure 1.2 or 1.5 or 1.75. If it measures 1, that means that its volatility is identical to the market. If it measures 1.2, that means that its volatility is 1.2 times the market historically. And the theory goes that if historically a stock has been more volatile than the market, then we're going to calculate that beta and multiply it times the risk premium. And that's going to be the formulaic expression of how we require a higher rate of return for a more volatile stock. Conversely, we're going to require a lower rate of return for a less volatile stock. So that risk premia multiplied times the beta gives us that threshold for an individual security. And then we're always going to add back that R sub F term because that's our time value of money. And that CAPM equation is one of the bedrocks of just finance and investing in general. And I would say if you came away from your master's program knowing just one formula, that might be the one. And that's definitely going to be on a CFA exam. And if you go try to get a job in any investing related field, they're going to expect you to know this. Now, there's a lot of shortcuts, and I mentioned the one that Buffett uses, and you may or may not see this in practice, but you need to know it. Okay. Um, I like this little bit of terminology here because it starts to get at some of the flaws associated with this model. Beta is it's an estimated term, and we calculate that based on a regression. So we're looking at historically how volatile has the stock's return been. Well, I have a problem with that right away because I'm not interested in the past. What I'm interested in is the future. And to the extent that a company's past volatility is not a very good indication of their future volatility, the whole formula breaks. So that's another one of the reasons why I like to start everybody in class by picking from a list of dividend aristocrats, because those companies have a very stable operating history, and generally that estimate will hold. Okay, on beta is also calculated on a market index of returns. So we're comparing that volatility to the market's volatility. Okay, what is the market? Is the market the Dow? Is the market the Nasdaq? Is the market the S&P 500? Is the market the global stocks? I think what you're going to find is that most of the time it's the S&P 500. And most of the time that's a pretty reasonable representation of quote unquote the market. But sometimes it fails. Sometimes that's not a very good representation. You just need to be mindful of that. And then lastly, usually we're using a time period of 36 or 60 months. But if it's 36, well, we haven't seen a bear market in the last 36 months, maybe with the exception of COVID, but that round tripped itself in 6 weeks, so I have a tendency to dismiss it. We haven't seen an economic recession in the last 36 months, so that period of time can be very sensitive too, and may or may not be a good representation of what we're after here. So having said all that, I'll just leave you with this is the best estimate that we have so far, and you need to know it because it is one of the bedrocks of finance and investing theory, but it's not the only way to um, calculate the value of a firm. And as we get into next week, we're going to be talking about, yes, I do expect you to use a discounted cash flow analysis on your research projects, but then I also expect you to use historical valuations and peer group valuations to triangulate in on a valuation that you can defend. Okay, we talked about everything on slide 16. This is one of my favorite slides because I used to work in a quant shop. And a quant shop, is right here. Um, this conversation that we're having can get very, very complicated. And one of the rather simplistic aspects of CAPM is that all of the cost of capital is linked to one variable, and that one variable is relative volatility. How volatile is this stock compared to the market? Well, what if there were better indicators of a stock's true underlying economic level of risk? What about their sensitivity to the economic cycle? What if one of the betas was sensitivity to a bear market or a bull market or the consumer price index or some other economic indicator? Well, this equation shows multi-factor models. And this was years and years ago, but I used to work for a quant shop, and we took an analytical view at the markets and broke stocks risk level down to 64 independent variables. And those 64 independent variables all varied by industry. So it mattered. We called them payoffs or factors. The factors would vary based on whether or not we were looking at a banking stock or a utility stock or an energy stock or tech stocks. And then they would vary again based on what cycle of the economy we're in. So economic cycles generally have an early bull, a late bear, like an early bull, a late bull, an early bear, and a late bear. That's kind of how the economy cycles. So in a sense, we had 67 models times four different cycles. And I caution students who are interested in quantitative finance because you need to have a good understanding that when you get into this aspect of our world, of the investing world, you are quite literally competing against the brightest minds coming out of the computer programming parts of Caltech and MIT. And one of the stories I like to tell, now it's all about big data, artificial intelligence, algorithms. This is dated, but 10 or 15 years ago, some of these bright minds figured out that they could correlate Walmart's earnings to satellite data that showed the number of cars in Walmart's parking lot. And it worked until it didn't. Meaning that when you get into this aspect of finance, some of these factors work for brief periods of time until the rest of the industry catches on, and then they don't work anymore. And that's called signal decay. And that goes back to efficient market hypothesis. So that's a little bit beyond the scope of this class. I just wanted to know that that does exist. And if you hear multi-factor models out there, that's what they're referring to. Okay, let's talk about the weighted average cost of capital. So we talked about the cost of debt. We want to compute a pre-tax cost of debt. We've touched on that several times in this class. There is an interest tax shield. So when we create our discounted cash flow models, we're going to calculate that cost of debt at pre-tax, which is simple. That's just one minus the tax rate. And okay, touched on all that. Our authors take us through an example of calculating that cost of debt, but it's all review. So I'm going to leave that as a refresher if you need it. I doubt you will, because I want to talk a little bit about the weighted average cost of capital, which is dependent upon that equation that I showed earlier, which was the intrinsic value of the firm equals the intrinsic value of the debt plus the intrinsic value of the equity. That split between the intrinsic value of the debt and the intrinsic value of the equity will determine how we calculate the weighted average cost of capital. So if a firm is financed with more debt, then the cost of debt is going to have a bigger influence on the WACC. If the firm is financed with more equity, then the cost of equity is going to have a bigger influence on the WACC. And you can see that expressed in the equation here, which is the R sub W, weighted average cost of capital, equals the R sub D, or the cost of debt, times the percentage of the firm that's financed by debt. Add the final term, which is the cost of equity, R sub E, times the percentage of the firm that's financed with equity. That looks like a lot, but it's not as complicated as it sounds. If we look at this example here, NextEra, which is a utility firm, we're calculating a weighted average cost of capital at 4.89%. So R sub W, weighted average cost of capital, equals 0.77%, which is their cost of debt, plus or times the percentage of the firm that's financed with debt, which is 61,000 in debt, that's the numerator, divided by the intrinsic value of the firm. Then we're going to add to that the 6.42, which is the cost of equity, times the percentage of the firm that's financed with equity. And then throw all that into a spreadsheet, and the 4.89% would represent the weighted average cost of capital. Now, what I find a little odd about this example, and I've reached out to the authors of the book, but I haven't heard back from them. I'm hopeful they'll change this in the next version of the text. But this cost of debt, does that jump out to anybody else? That bothers me. Anybody guess why?
Because it's so high.
Well, it's the other way around. It's because it's so low. If it were 77%, that would alarm me because it's so high, but it's 0.77%. So this is actually expressed as a percentage, which means that it's less than 1%. And we just talked about how the value of a US Treasury is 4%. So in this example, they're paying less than the risk-free rate. So that's highly unusual, and I think that the authors could find a better example here. It's not it looks like nonsense to me, but the math behind the equation still squares, so we can use it. But I like to throw it out there just because I want to encourage everybody that's working on your projects to approach this with a good smell test. You got to be able to smell the BS. If something just doesn't seem to square, it probably doesn't. And bring it to my attention. Because if you can't trust the accounting, or even if it's just you can't understand the accounting. Like I remember doing some work on Washington Mutual in 2005. And I went to my boss and I'm like, I don't understand the accounting. And we own some Washington Mutual and we own some US Bank. And I told him, sell all that Washington Mutual and just buy some more US Bank. Because US Bank was well run, they had simple accounting, they had a good management team, they met all the four M's, I could understand it. I couldn't understand what Washington Mutual was doing, reselling all their home mortgages and packaging them into collateral securities. And that turned out to be one of the best recommendations I'd ever made because SWAMU eventually went bankrupt. All right, actually, I think they got bought out by Wells Fargo, but it was for pennies on the dollar. Okay, let's talk about that cost of capital. What if it wasn't a weighted average cost of capital where we were trying to discount the cash flows from the firm? What if we were just looking at cash flows to equity holders? Now, what are cash flows to equity holders? Well, if you own a stock, the only way you're getting cash flows is if they pay a dividend. And that's another one of the reasons why we select from companies on the list of dividend aristocrats, because they lend themselves to multiple forms of analysis. And this is the dividend discount model. Hopefully, you've all seen this before. If we're going to value a company using the discount, the dividends, well, we can start right here with this formula. The intrinsic value of that company is equal to the dividend that they're going to pay next year, plus the intrinsic value of the firm next year that we would get if we sold the stock. Divide that times 1 plus R sub E, which is the cost of equity, and you get the present value of the security. Now, that's a very simplistic way of looking at a business, and it assumes we're going to sell next year. What if we don't have any plans to sell next year? Well, then, hypothetically, theoretically, the present value or the intrinsic value of that business would be worth the future cash flows would show up in the form of dividend one, dividend two, dividend three, all the way to perpetuity. Each one of those cash flows would be discounted back at the cost of capital. And we have a formula that shows dividends into perpetuity. So ultimately, what we're going to need to see is this terminal year period where we show, dividends n over 1 plus r to the n, and that shows up as something that we call the Gordon growth model. So in the Gordon growth model, we have the dividend next year divided by the cost of equity less the growth rate on that dividend. And Dividend Aristocrats, again, works well for this formula because this is a list of companies that have been successfully growing their dividends for the last 50 years. Now that forecasting methodology, it's kind of like beta. It has warts all over it. And it doesn't work if a company's not paying a dividend, and it doesn't work if your dividend's unsustainable, and it doesn't work if the dividend's hard to forecast. And take every valuation methodology that we're going to be looking at this semester, discounted cash flow, beta technique, dividend discount model, they all have warts all over them, which is another one of the reasons why we use them all. And we try to zero in or triangulate on something that we can actually have some conviction in. And you get better at this over time. And you learn that some of these valuation techniques are stronger inside of certain industries. The DDM model works well for the companies that we're looking at. Um, cost of book value methodologies, valuation methodologies, they work well with banking institutions, with utilities, so on and so forth. Okay. I love this sensitivity analysis. This is a great exercise to go through. Yes, for a dividend discount model, but even more so for your discounted cash flow model or your forecasting methodology, anything that you're using to value a security that is highly sensitive to an individual piece of data. And I've mentioned this a handful of times this semester. Finance and investing, whenever you're working in finance or investing, it's important that you have a good understanding of materiality, and it's important that you have a good understanding of precision, because it doesn't matter if you get the lease accounting right to the second decimal point, if you can't get the discount rate right. It doesn't matter if you get the deferred tax assets and deferred tax liabilities right to the second decimal point if you don't get the growth rate right or the margin right, because those latter variables are so much more meaningful to your ultimate analysis. So spend the right amount of time analyzing the correct data so that your analysis is rightly ordered. And in this little chart that our authors give us at the bottom of the page, we show growth rate along the top and discount rate along the side. So we're varying our discount rate from 5.4 to 7.4, and we're varying our growth rate from 2% to 4%. And if you look at that scenario analysis, it yields a stock price of somewhere between $34 a share and $131 a share. Well, that sounds ridiculous. You're gonna if you were working for me and I said, how much do you think Campbell soup is worth? And you say, I think it's worth somewhere between 34 and 131, I'd say you're fired. So this analysis is not very useful other than to illustrate how sensitive the valuation is to these different numbers. So um, you can also use this to kind of back into, well, let's say Campbell Soup is trading at $100 a share, or Pfizer is trading at $100 a share. Well, then just reverse it, flip it on its head. You can do the analysis in reverse and ask yourself, okay, what discount rate or what growth rate does that imply? And then you can say, in order for me to be comfortable paying $100 a share for Campbell Soup, I require a discount rate of at least 5.92 or a growth rate of at least 4%. And then, um, well, it's basically the same mental math. You're just approaching it from a different angle. And then you're asking yourself, okay, does it seem reasonable to me that this soup company can grow at 4%? Maybe it does, maybe it doesn't. That's where all the other analysis comes in. And that's just for reference. Okay, gang, that's cost of capital. I told you tonight would be a quick lecture. It's all review. I'm also hopeful those will be easy points for you on the exam that we have coming up. Anytime in the next 2 weeks, take that. Let me know if you have any questions in advance. But that's all I got tonight, gang. Any questions before we adjourn? Okay. Hearing none, I will wish you all a good night and just give me a ring over email if you need any help. Thanks all.
Thank you.